record?
Yeah, it's already.
Sorry, recording.
Yep. All right.
I guess we're missing on this.
That works. Thanks.
It's a good way to try to memorize information for the financial product development and innovation stuff.
Yes.
So.
Yeah, so the first thing I'm going to look at for the financial product innovation is do you know how to do the S curves? Do you understand the product analysis?
The financial product innovation. It's like below the S curve. Like
All right.
I can memorize that stuff. So it sounds like it's kind of easy. I got the S curve on the contest, but.
Yeah, everybody messes up on the S curves. They don't know how to draw them. So this is going to be the technology. Technology innovation. This is time. Okay, and the S curves look like this. Boom. 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 S1, S2, S3, S4, S5. How many technologies do you think Microsoft has basically developed over the years? It's all in the detail, right? I learned this in my operations research management class, and when I was doing my doctorate, Dr. Nabil Braga, who got his PhD in operations research from UC Berkeley. T1, T2, T3, T4, 5, T6, T7, right? And then T1, T2, T3, T4, T5, T6, T7. So that's what I'm looking for the S curves. And basically the S curves are technologies or processes that have basically been developed either by the industry or by the major players within the industry consecutively over time. So you go to the Chicago Mercantile Exchange, the majority of the office is basically an IT shop. Same thing with the New York Stock Exchange, same thing with Goldman Sachs, Merrill Lynch, B of A, Wells Fargo, they're all technology shops. So they create their own technologies internally to basically solve problems, scaling problems, economies of scale, economies of scope, to be able to handle just the data intensity associated with the amount of volume that they deal with. Billions of basically data points that you have to deal with. And then obviously you have Salesforce, Oracle, Apple, those guys do exactly, IBM, they all do the same thing. So basically here are your S curves, and again, you know, they start off and then, you know, the productivity, you know, accelerates, you know, by the technology or the revenue. It's just like the product adoption cycle, but we're using technologies instead of products. And then the company's ability to be able to consecutively develop new processes and technologies over time basically communicates to the marketplace the ability to basically generate an upward sloping innovation and an upward sloping revenue curve. And that if they can communicate that to the marketplace, cash flow, T plus N, right? So it's basically T equals infinity, right? Basically the cash flows are expected to basically go out forever. These companies last, in some cases, over 100 years. Divided by the expected return minus the growth rate in the cash flows. Well, if they can do that, then they can maximize the growth rate in the cash flows over time. If they can maximize the growth rate, then they're going to maximize the value of the firm. their ability to do it over and over and over again and be successful. Developing technologies and processes. And financial products are basically tools, they're technologies. There's no difference in using the technology and operations research theory to basically apply to the finance. Okay. And then the product adoption cycle is basically taken from the marketing literature. How I do it. And here you get the innovator stage, you get the adoption stage, you get the majority adoption stage, late majority stage, and you get the laggard. This is your innovator. And people who are in the innovator stage will adopt a product once it comes out because they want the coolest product. They want the right when it comes out. But you're not going to make any money here. Because basically your cash flows are probably negative during that time period. You spent a lot of sunk cost in starting up the product. You know, your net present value, negative. Your IRR, negative. So you're not doing anything at that point. So you're just spending money. And then all of a sudden, now, because of social media technologies along with handheld computers and applications, websites and all that stuff, I can basically sell a product, into the marketplace and basically penetrate and market to hundreds of thousands or even millions of people instantaneously through social networking, LinkedIn and Snapchat or WeChat or whatever, LinkedIn, Facebook. So then you're in the early majority. So all of a sudden, your sales take off. Okay, and you start to scale. This is called the hockey stick. And at that point, your cash flows are growing very rapidly. Your costs are going up significantly. And if there's a delta between your costs and your revenues, then you're generating profit, okay, during that time period. And then at some point, everybody's adopted your product. I mean, everybody has stocks and bonds in their portfolio, basically, or exposed to it. So then you move into the majority phase. Well, your revenues are still growing, but they're growing at a decreasing rate, so it's the second derivative calculation. And then here, some people are still adopting, but basically the growth in the revenues have basically been extended, and actually your sales are probably starting to slow significantly or turn negative. This is your late majority. And then the laggards are the ones that wait till the very last minute. Now the key to this one is just like the key to the S-curves, is if you can develop new product consistently over time, you can create a revenue growth path. And the market will expect you to be able to do that. Because now you have a brand because you've done it over and over again. Well, the revenue growth path, once it's established in your ability to communicate to the marketplace based on your brand, that you can generate new products consistently over time, and lock in those clients and upsell, cross-sell them, then you're going to create that upward sloping revenue growth path. And if you can maximize this revenue growth path, you're going to maximize the value of the firm. So this one's based on technology, this one's based on products. It's the same basic theory, but this was taken from the operations and research in the industrial engineering space, and this was taken from the marketing literature, marketing space. That's what I'm looking for. The list is the list for that question, and then these are the things that I'm looking at. So these are the things I go to first. Do you know how to draw the S-curve? Do you know how to draw that stuff? And do you have this equation? Do you understand?
Is that the Gordon growth?
That is the Gordon growth. But it basically just states that if you can consecutively develop technologies successfully over time, you're gonna create a brand, and the brand's gonna reflect your ability to basically generate a constant growth in your revenue or your cash flows, because the marketplace now knows that you can generate consecutive technologies over and over again. And these large financial institutions are developing derivatives and risk management tools. They're constantly developing new technologies. And they're also developing new retail or industrial, institutional products to sell into the marketplace. So there's both an engineering piece and then there's a marketing piece in this solution. So what I've decided to do is to bring in advanced level management theory into the finance course, so you can see where it's applied. Because I'm asked all the time to do strategic planning stuff, to do this stuff. Okay. You can take a picture of that if you want to.
So that makes sense then. With more growth, when your growth hits max, then your value will
You're just maximizing the growth rate.
Right.
So you're constantly maximizing the growth rate because you're introducing new technologies and products over time.
Yeah.
Same thing with the new products over time. So you're growing your revenue at a constant rate, but you're maximizing the growth rate,
Mm-hmm.
and you're maximizing the value of the firm. So if you can maximize that, you can maximize that.
Oh, so is the product adoption just a close-up view of one of the S-curves here?
No, because these are technologies.
Oh, okay.
These are products. Although products are technologies,
Okay.
but these are more technologies.
Okay.
These are processes and technologies that are innovative.
So
All right.
theoretically, if you were to stop innovating new technologies, you would sort of hit that laggard look on the product adoption.
If you stop right here, that's it. I mean,
Yeah, you
IBM stock price is down like 3 to 5% because they don't innovate like.
They've been around for a long time.
They've been around
from
a
the beginning,
long time.
and now they're slowing down. Right.
Yeah, the revenues are still.
Amazon is probably near that.
They're doing
early-
this, and
yeah.
Amazon's doing
Yeah.
that. Salesforce is doing that.
Yeah.
Doing that.
But maybe when they get
BlackRock's doing that. BlackRock's doing that. Goldman's doing that and that. JP Morgan's doing that and that. B of A, Wells Fargo, Citigroup. You know, maybe some institutions out of Europe and maybe out of China. Probably. Because China's on fire when it comes to technological innovation these days. Okay, so did that answer that? Okay. And then the hardest part on that last question piece is the, you gotta remember you have number 6, which is financial feasibility. Okay, net present value, internal rate of return, break-even analysis. All those metrics, because you can't develop this stuff until you figure out if it's feasible. Because if it's gonna cost me $5 million to develop this stuff, but I'm only gonna make $1 million, I'm not gonna, it's like, it doesn't make sense, so I'm not gonna do it. So I gotta apply the financial feasibility, which we haven't gotten to in class, because we're gonna be doing capital budgeting in chapter 10. Okay, but I put it in here anyway. And then number 7 is important, because you have to have a rules-based system, basically laid out that says if all of these criteria are met, then we're gonna enter the marketplace. We're going after it. And then after you've developed it, then you have to make a decision. Do we spin it off? Do we keep it? Do we take it public? You know, how do we create what's our exit strategy? And if the product fails or it's not performing, then we're gonna discontinue the operations and take the tax deduction. You know, or we're gonna spin it off to somebody else. Or if it's really successful, we're gonna keep it and generate internal cash flow, which will be our cheap source of capital to fund our other projects. Or if we see that we can arbitrage and spin that unit out and take it IPO and make $7 billion off of it, you know, instead of just $1 billion or $2 billion from the cash flows. If I can get $2 billion, but I can get $7 billion and still, you know, own a majority share in that company, then I'm gonna take that $7 billion that I get and do it again in 7 more companies or 3 more companies and do it over again. Okay, so that's what that piece is. And then the rest of it's just a list. Okay, and if you get, this is probably the most important. I mean, it's all really important, but this is really important. I've had a bunch of students that totally get this and say, I want to do that. How do I do it? It's like get really good grades and go to Wharton, okay, or Stanford. All right. So next, what's the next question?
Can we do B?
Which one's that?
Macroeconomic foundation.
Yeah, that's a good one. Okay, are you guys down with this?
Yep.
Yeah, that's a good one too, because the book's a little out of date. It mentions the financial crisis, and the financial crisis is a big deal, especially since we're gonna be in finance. And I keep talking to these employers, and they're gonna wanna know that you know this stuff, okay? Maybe I actually would ask you some of this stuff, okay? All right, so, got it. What is the size of the Federal Reserve's balance sheet? Okay, so, and I've seen different numbers, okay, so don't hold me to this. 2007 00 0010. Okay, like that. So the Fed's balance sheet during that time period. Now, the Fed's balance sheet, let's just take it here, 18. So in the last 10 years. So the Fed's balance sheet currently is 4.1 trillion. And it got as high as, I'm gonna say 5.3 trillion, just to be conservative. Okay. And then, so that's the balance sheet. Right? So this is their assets, right? And liabilities. These are the assets that are made up of usually U.S. treasuries and mortgage-backed securities. Liabilities, most of them are reserves that banks hold on their balance sheet. Okay, so the assets have to equal liabilities. So that's the trick question right there. Is what is the Federal Reserve balance sheet? Currently, it's about 4.1, but it got to as high as 5.3. So that's the assets. And then the reserves are exactly the same. So they're exactly the same. Okay? So the balance sheet is currently 4.1 trillion, and the reserves are currently 4.1, but they got as high as 5.3.
And prior to 2007, it was
Yeah,
5.
prior to 2007 was 500 to 800 million. Okay. And then prior to, I would say for about 30 years, I would say, let's just say 1950 to 2000, let's say that this was 2006, 2001, let's say, just say something like that. And then prior to, it was all the way back to 1950, it was around 250 billion. So it's just a matter of magnitude, that's why I gotta like expose this stuff to you, because this is pretty extreme.
They significantly increased.
Yeah, and if you look at going back in time, you know, 1970, went like this, and then in 2007, it was like this, and then it went, you know, like that. It's never happened before. We never printed so much money in our life. Okay, and then the second question, what has been the growth rate of the money supply since 2007? So the growth rate in the money supply, right, in 2008 through 2010 was 30 to 40% was the growth rate. And prior to that, it was basically, it wasn't very fast. So this is really high. Okay. And then 2011, let's say to 2013, it was growing at about 10 to 8%. In 2014, 2018, 17, 16, 15, 14, so 4 years. 3 years. 15, currently in this period, it's like 5%, 3%. So you can see the growth rate in the money supply started to slow down.
So what would we write for, since 2007?
Well, probably if they can do it, I think it would work.
Yeah, it's right here.
Oh, 30 to 40 total.
Yeah, since 08 to 11, it's 30 to 40, from 12 to 15, it's 10 to 8, from 15 to 18, it's 5 to 3%. And if you look at the monetary base, it basically went like this, and then like that, and now it's going like that. And stock prices kind of follow the growth rate in the money supply and the growth in the monetary base. So the question is if the Fed's selling off the bonds and shrinking the monetary base and driving up interest rates and driving up liquidity in the marketplace, what's going to happen to stock, bond, and real estate prices?
It's going down.
Probably not going to happen.
Do you know how much of the money supply they're going to try and shed?
Hmm?
You know how much of the money supply they're going to try and shed?
Well, they're already slowing the growth rate in the money supply.
Yeah, so if that,
Okay, and if they sell off the bonds, right, from the balance sheet, right, to sell off the bonds, then what they're doing, they sell the bonds, right? They sell the bonds, people buy the bonds from them, they pull money out of the system.
yeah.
So the money supply could shrink.
So this is related to yield curve too.
It has an effect on the yield curve too, because as the money supply shrinks, there's not as much money, the Fed's not buying as many bonds. They might actually be selling bonds, and if they're selling bonds and not buying as much bonds, that's gonna drive bond prices down and interest rates up, and it's gonna shift the yield curve up, flatten it, or maybe even invert it.
So when it inverts, does that mean the money supply is also shrinking?
On the short end,
It's shrinking.
yeah, because they're
so
selling the bonds, driving down bond prices and pulling liquidity and pulling money supply out of the short end of the curve.
Okay.
And people are worried that there's not gonna be enough treasury securities on the short end, for one, and there's gonna be liquidity problems at some point, because they're pulling so much money out. All right, what is, they got that one, has the Fed hit gross domestic product? Okay, this one, you'll get the bonus points. So the quantity theory of money, okay? Quantity theory of money basically states that GDP real times the inflation rate is equal to the velocity of money times the money supply growth rate. Okay, and this is the identity. This is where you get extra credit, bonus points. So over the last 10 years, real GDP has basically grown at 1.7%. Inflation's basically grown at 1.7%. The velocity of money has dropped from 9%, or 9 times, to 6 times. This is the number of times currency circulates through the economy on an annual basis. And then the money supply growth rate, as we know, has basically dropped from basically 35% to 5%. Okay. So the problem was that inflation wasn't an issue, right? And actually the Fed was targeting 2%. So they weren't reaching their targets, okay? And their target here is 3%. And they weren't reaching their targets over the last 10 years. They weren't targeting the volatility, and they were targeting the money supply. So basically the solution here was Money supply was having no effect on real GDP. Money supply growth was not having an effect on inflation. So if they were growing the money supply at 35%, you'd think that GDP inflation would have gone up. It didn't, because the velocity of money collapsed. So as they were growing, the money supply velocity was declining, so there was no impact on GDP or inflation. So they were in a bind. Okay.
So what do they do?
Well, actually, the number one variable that drives velocity up, because as we know, the money supply is slowing. Velocity is actually increasing again after it collapsed, and it's due to
Due to spending?
due to employment and wage growth.
Sorry, the velocity of money is just how much it's moving around, like if everybody's.
Number of
holding-
times. So if everybody's employed, everybody's making money, people are investing, saving, and consuming. Okay, so they're using more money, so the velocity is higher.
Okay.
Okay, it's the multiplier effect.
So those probably, it sounds like those two might not have much to do with each other, velocity and money supply.
Maybe not. That's a good observation. They were decoupled. So the Fed was printing all this money, the velocity was collapsing at the same time. So there was no effect on, and the number one factors that drive velocity is employment and labor participation rates and job growth.
Did they used to be related, like correlated?
You would think if they increased the money supply, that the money would turn over more as interest rates fell.
Yeah.
So there's probably some kind of causal relationship to it. But I would look at it as separate. Okay. So the unemployment rate's now starting to move up, and I haven't looked at the velocity numbers, I'll see what they've got. The money supply has come down. Okay. But the targets over here, we've now got wage growth of 2.9%, and the GDP deflator, which is what the Fed targets, is now at 2%, and core inflation is now at 2% too. So the question is, has the Fed hit its target on inflation? You got a problem? Are you confused?
No.
Okay. So has the Fed hit the inflation targets?
Yes.
And then the GDP number that just came out in 2Q18 was 4.1%. So did they hit their GDP targets?
Oh, yeah.
Got
So
it.
the Fed is hitting.
And the unemployment rate target is 5%. And unemployment rate now is 3.8. As of, we'll just use 2Q18. So did the Fed hit the target?
Yep.
Got it. So they've hit the targets for all of these things. So the question is, if they hit or exceeded the targets, are they gonna raise or lower interest rates?
Raise.
They're gonna raise interest rates. Right? Because the economy's already overheating, and inflation is starting to kick in, and wages are starting to kick up, and we're at labor constraints. So the Fed's gotta move in before inflation turns into hyperinflation, and people start rioting because their money is becoming worthless because of inflation. And you're already seeing it with oil and gasoline, and energy, and education, and healthcare, and the list can go on.
Say oil prices spike usually before a recession,
Yeah, because the demand is so high.
and it drives. Okay.
So then the question says, if we fall into a recession, would the Federal Reserve use negative interest rate policy? The answer is yes. Negative interest rate policy. Yes. If you look at the yield curve in the United States, it was like this. Zero bound, and it went like that. That was the US. And currently the US yield curve is like that. So this is today. So the yield curve is gone up. If you go into Germany, they had negative interest rates. And if you look at Japan, this would be the EU. This would be Japan. They currently still have negative interest rates. We don't have zero anymore because they're positive.
Why are the curves going up then? Is that the yield curve?
It's an upward sloping yield curve because of the future inflation expectations. But this kind of gives you
Still
an
in the
idea.
negative.
Huh?
They're still in the negative right now.
On the short end.
Okay.
But we never went negative. But they said if interest rates are still historically low, so if we fall into a recession, there's probably not going to be enough stimulus from zero interest rates, because interest rates were already low. So they're probably going to have to go to negative. And they've already talked about it, going negative if they have to.
Trump didn't like that.
Huh?
Trump wouldn't
Well,
like
he
that.
doesn't even understand this
I
stuff.
gotcha.
So the question is, what is the impact on the economy? Well, the way I would look at it is, here's my cost of equity, right? And this is my, let's say my earnings per share. I can also use dividends. Right? And I'm trying to figure out the value of assets. Maybe stock, bonds. If I use real estate, I'd use net operating income. So to get these values, what would it do to the economy? Well, if I use the capital asset pricing model, well, if interest rates go negative, this goes down, right? Right?
Mm-hmm.
This goes down. If this goes down, and this goes up. Okay. So if they drive interest rates negative, then the cost of capital is cheaper. So people's business loans, student loans, car loans, corporate, bonds, the cost of capital goes down when you drive interest rates really low.
So that stimulates things.
So it's going to stimulate the economy because it's going to be cheap to borrow. So
the
people
net-
will borrow and they'll consume and invest, and that'll create a multiplier effect and stimulate the economy.
Does that mean when we get out of college, our loans are gonna be a lot?
I don't know if your loans are variable or if they are fixed.
Oh, so it depends on,
It depends on the contract.
yeah.
Okay, but usually, the loans are really expensive. That's why you want to pay them off as soon as possible. So it's going to be stimulative for the economy. Economy. Stimulative. What's it going to do to asset prices? It's going to prop them up. It's going to prop up asset prices. What's it going to do for savers? Well, if the interest rates go negative, right? So they go negative. Well, anybody who buys those bonds, anybody who buys the bonds is going to be getting a negative yield to maturity, which means that you're basically buying the bonds and you're being taxed. You're being taxed on them, okay? And then in the future, when you get your money back, you're not going to get the premium. And your interest rate is negative. So you're actually paying the government to hold your money. And you're only doing it for liquidity purposes. So you're willing to pay the government to hold their bonds for liquidity purposes, with no real return. Okay. So the savers are going to get totally hosed. Okay. But the people who actually hold the bonds, if they held the bonds, bought the bonds at higher interest rates, and then as interest rates went negative, they're going to get a wealth effect, all right? Because as the interest rates go down, the value of the bonds are going to go up. But the people who bought the bonds in negative interest rates are going to get housed.
So
Okay?
if you're selling bonds, you're good for buying.
If you bought the bonds at a higher interest rate, and interest rates go down, and the value of the bonds go up, you'll be fine. But if you bought the bonds at a negative interest rate, you're going to get housed. So savers are not going to be, they're not going to do well.
So if interest rates go negative, nobody's gonna buy bonds.
They will continue to buy bonds out of fear and for liquidity preferences.
Why wouldn't they just have cash?
That's an argument, actually. It's like if the prices are falling and the government's offering me, negative interest rates, why don't I just hold cash? But you have storage costs. Where are you gonna put it?
Mattress.
You put it in the mattress. Well, actually, probably. Well, that's what they did in Japan.
I mean,
They put it in. They put it in safe.
the cost to keep it in the bank, like that.
You're gonna have to pay.
Oh,
So
we
you're
pay
getting a
the
negative
rates?
interest rate. Yeah. So you'll get like a really small interest rate, but then they'll charge you a fee. So you're actually getting a negative interest rate after the fees. And then a lot of Japanese actually put their money into safe deposits, into safes in their house. And when the tsunami came, they were finding safes.
Oh my gosh, like gold mines.
They were finding safes where people had stored their cash because they had negative interest rates and inflation was actually there was disinflation. So they were holding cash. But there's problems in holding cash. Large banking institutions can't hold cash, so they're forced into buying these negative interest rate bonds, which eats into their profit margins. Okay. So that's kind of the circular. And then investors are going to benefit, right? Because as interest rates go negative, the discount rates go down and the values go up. So the investors, if you own any investable assets, you're going to benefit. Okay. But in the United States, like 95% or 90% of the population owns no real estate, no bonds, no stocks. They don't own anything. It's the top 90th percentile that controls basically 90% of the world.
That's why you said when the interest rate goes negative, when it inverts, the stock market peaks because at that point it's driving stock prices up. Then I'm guessing when it crosses the inversion line going back up, that's when the stock market starts to.
Well, it did. Once it inverts, then banks start hurting and they start pulling back on their cash, on lending. And then corporations that actually borrow on the short end of the curve, their cost of capital goes up significantly, and they start to abandon projects. And they don't fund stuff, and then it just flows through the economy. Okay. And then what about businesses? Businesses would benefit in the short run, okay, through lower cost of capital. But the problem is that over time, right, if negative interest rates are indicating a depression or a severe recession, then eventually it's going to affect the earnings per share. So in the short run, it'll affect their cost of capital, which will prop up their stock prices. But as aggregate demand starts to fall because of recession or depression, it's going to affect their earnings, and that's going to cause the stock prices to go down.
So stock prices.
But we didn't see it this time around because basically the Federal Reserve basically propped up asset prices by really driving the interest rates to zero and propping up the
During the
prices.
recession.
Yes. Yeah.
So their stock prices would still go up even if the interest rates became negative for a little bit.
If these go negative here, this is not going to turn negative because you still have the market risk premium. Okay, you still have the market risk premium. But if this goes negative, this is going to drive this down really low, and this is going to prop up stocks, bonds, and real estate.
So maybe I'm missing something, but when interest rates go low, obviously, like, you can't really, it's bad to store your money. You're trying to find a place to store your money that's good. Why would you not? I feel like everyone would put their money in stocks because those will potentially go up.
Well, what they did was they put the money, as interest rates started to fall, they put their money in bonds because they were scared and they needed liquidity. And as the interest rates went to zero, bond prices were at their all-time high. And people sold off the bonds because they were so high, and they bought into the stocks when they were at their low.
So somehow if you buy bonds before the fear and then things happen and
You buy
the fear, yeah,
And the bonds
then you
here at
make
their
money.
peak, then as interest rates go down, then the value of the bonds go up.
Okay.
Then you're getting higher coupon and you're getting high value, and then you wait for the market to bottom, right? And then as the market bottoms and interest rates bottom, right, bond prices are at their highest, and you sell off the bonds, you buy the stocks.
So you buy bonds at market peaks,
At interest rate lows, and in deep,
which
the
generally
bottom of the
happens.
depression, the bottom of the recession.
Buy bonds then.
No, you buy them at the peak,
Oh,
you're right.
okay, yeah.
You buy them at the peak, at the highest interest rates. And then when you fall into the recession and interest rates go down, then the bond prices go up. And then what you do is you wait to see the economy start to grow, you sell off your bonds, you buy stocks, and then you ride up the stock market. Then as the stock market peaks, you sell off the stocks and you buy real estate, and wait for the real estate to peak. And then you sell all that shit, and you go into bonds.
It's a cycle.
It's an asset allocation over the business cycle. And you guys probably got three business cycles ahead of you, maybe four. It's every 10 years, so you got 4 more to go through. I went through the early 80s, 90s, 2000, 2008, and 2010, so I've been through 4. I'll probably go through another, so I'll go through 5. Okay, next question?
2 more.
I hope so. Okay, next question. You want to take a picture of that? I'm giving you a little bit more than I went over in class, okay? Which is your benefit. And then you're gonna have to kind of time yourself, you know.
I guess there were a few questions I had on the modern portfolio theory.
Yeah, okay, can I erase this?
Sure. I don't know if it'd be easier just for you to
Yeah, I'll do it.
demonstration or.
I'll do it really quick. Because the first thing I'm gonna look at is, did you go off the efficient frontier? And did you put in the wealth effect from the insurance? That's the first thing I look for. And then I'm gonna see if your utility your utility curve is tangent to the capital allocation line in the efficient frontier. That's what I'm gonna check. And then I check to see if you put in the 100% stock and the 100% bond portfolio. Okay. And then the efficient frontier umbrella, the capital allocation line. Did you show how you can jump off the off the efficient frontier onto the capital allocation line through leverage, off and down through lending? Exactly. And then, at the market basket is where you maximize the return to risk ratio, or the risk adjusted rate of return. And then the other is just what were the model portfolio allocations, how did they shift over time as new asset classes were added to the basket.
If I didn't remember the name of the study, will you?
This is Ibbotson.
Ibbotson?
Yeah.
Okay.
And then Reef, DB Reef.
Okay.
I can
What
show
was
you.
the DB Reef?
DB Reef was the alternative renewable energy.
Oh, got it. That was the most recent
Yeah,
one.
the last two were Ibbotson. They did the
Okay.
real estate, and then they did the life insurance.
Okay.
They did the analytics around that.
I guess the one question that I really have is how it relates to the inverse coefficient of variation rate, and what are the 2 objectives?
Yeah. So the capital allocation line, and this is how I do it. Okay, so you gotta do it my way, or else you'll screw it up. So you gotta go like that, and you gotta go like that. And this has to be higher than this. Okay. And then you throw in the umbrella. That. And then you put in your 100% stock, 100% bond. And then we put like little dots here, little dots there. And then put dots into here. So these are all the portfolios I can construct along the efficient frontier inside of it. And then what I do is right here, I put in the tangent utility curve, and then put in the others. And I put in the lines. Because investors want to be here, but there's nothing out there. So they gotta lower their utility to get the market basket. And then at the market basket, this is obviously the expected return on the portfolio. This is the portfolio standard deviation. This is going to be ER star. This is going to be standard deviation star. At that point, your expected return on the portfolio over the portfolio standard deviation, you are going to maximize the risk adjusted return. Risk adjusted rate of return. Got it. Okay. And this is 100% And nobody puts in these things, which drives me freaking crazy. Right? And then this is your risk-free rate right there. And then I got ER bonds, standard deviation bonds, I got standard deviation stocks. This is my expected return on the stocks. Got it. Okay. And then what I do is I show how I can move up the efficient frontier by selling bonds and buying stock. I can move down the efficient frontier by selling stock and buying bonds. I can jump off the efficient frontier and onto the capital allocation line. Move up to here, where I'm going to get very high return at a very high risk through the use of leverage. Leverage. And leverage is applied in your stock portfolio through the margin account. And I can lever up my real estate through mortgage. I can also jump off the efficient frontier. Here, and move down the capital allocation line to, let's say, here. And I'm going to get there to lending because the banks are willing to lend you the money on your stock and your real estate, but your stocks and your real estate got to be collateral. And if you can't pay the margin, at the margin call and you can't pay the mortgage, then you default and they're going to basically foreclose on your property and take the property, or they're going to liquidate your stock portfolio and pay back the loan on the margin account. Okay? All right, so that kind of sets that up. Then I get to your question, right? But really it's, the question is first is what is the market basket? Okay, what's the allocation? What's the portfolio? And over time, as new asset classes are added to the universe, then the market basket shifts. Okay? And there's been basically like 5 major shifts over the years. And I would say from 1920 to 1970, in there, it was basically 70% bonds and then 30% stock. So if I was an investment advisor or a stockbroker, there was really nothing I could put my clients in except for stocks and bonds, and this was the allocation for risk-averse investors. And then from 1970 to 1980, we took for bonds 1,000 basis points, stocks continued to get their allocation, and you put 10% in real estate. Okay, and Ibbotson did the study here. And the reason why they added real estate to the composition, Congress did it through legislation called ERISA, that said public and private pension plans should have at least 10% of their allocation of real estate based on the Ibbotson study. And the reason why they said real estate was important is because real estate, because of the capital expenditures that you put into real estate and the leases are tied to inflation. So as inflation goes up, your cash flow goes up and the value of your real estate goes up. It's different with bonds and stocks and bonds. As inflation goes up, interest rates go up and stocks and bond prices go down. Okay. So real estate returns have low, no, or negative correlation with the stock and bond returns. Okay. And then from 1980 to 1990, we took again from the bond portfolio, stocks continued to get their 30%. Ibbotson did the research, Okay, you gotta have 10% in real estate, and you have 10% in cash value life insurance. Because the rates of return on life insurance and the payout of life insurance is not correlated to the stock market at all. So again, you're adding another asset to the stock bond portfolio whose returns have low, no, and negative correlation with stocks and bonds. Okay, so you're getting diversification there too. And then this was Ibbotson 2 also. And then Deutsche Bank Reef and Dr. Souza, 1990 to 2000 something, right, going out into the future. We took again from the bonds, because again, these have bond-like characteristics to them. We kept our 30% in stock, 10% in real estate, 10% in cash value life insurance, and we added in alternative renewable energy. So these, right here, these asset classes are called alternatives. Or alternative assets. And these alternative assets have no, low, and negative correlation in their returns with stocks and bonds. And that's huge. And these asset classes have been growing rapidly over the last 5 to 10 years as an asset class. So if you add these alternative asset classes to your stock bond portfolio and their returns have low, no, and negative correlation, what it does is it bows out the efficient frontier. It bows out the efficient frontier. Okay, I know that your expected return falls, but your portfolio standard deviation falls way more. So yeah, I'm gonna get a reduction in my expected return, but I'm getting significant reduction in my portfolio risk, which increases the risk-adjusted rate of return. And if I can get my clients an expected return of 8% to 10%, I can double the portfolio in less than 10 years. And that's what they want. So by using alternative assets, I can get diversification in the portfolio. Yeah, I'll get lower expected returns on the portfolio, but it gets a significantly less risk of the portfolio reduction, which increases the risk-adjusted rate of return. And if I can get an 8 to 10% rate of return, this portfolio doubles in less than 10 years. That's it. That's what they want. Okay. And the last is the life insurance piece. So for those high net worth individuals, or corporations that have highly valued executives and senior level managers in the company, they will get life insurance on their principals. So you, as you move up in your career, if you're insurable, they will ask you to get life insurance. They will put life insurance on you. They will, and disability insurance too, because they can't afford to lose you. And if they do lose you, the death benefit is injected into the corporation or into the estate. And the wealth effect associated with the death benefit jacks basically the expected return on the portfolio, but also moves the corporation and the beneficiaries of the estate onto a higher utility curve, which is where they wanted to be originally. And you can also bow out the efficient frontier. Also bow out the efficient frontier through the use of financial engineering. Where you're basically using derivatives as the tools to apply portfolio insurance. Which is huge. So if I have assets in my portfolio that are correlated to the stock, bond, energy, real estate indexes, and I think that the returns and the prices of my assets in the portfolio are gonna go down, if I'm a large enough entity, I can write forward contracts. I can write futures on an exchange. I can write call options on the futures that are offered on the exchange. And I can buy puts. Oops. I can buy puts on the futures on the exchanges to hedge off the market risk embedded in my portfolio. And if I own ETFs, which I probably do, and if I own stock in my portfolio, which I probably do, I can sell short. I can write calls, and I can buy puts to hedge off the market risk. And by applying these derivative trades as the tools to apply portfolio insurance, I can also build out the efficient frontier and lock in the expected return and actually increase the risk-adjusted rate of return through financial engineering as opposed to diversification. So that's the solution. Yep.
So would you, kind of off topic a little bit, would you recommend selling short in the upcoming years?
Yeah. Yeah, because the stock market's already peaked out, so once the sell-off starts to occur, then you would start to sell short.
So when
Or you would
see-
buy the puts or write the calls.
Would you wait until you actually see interest rates start falling though? Or?
No, no, it's, as interest rates start to rise, at
Right.
some point in time, it's gonna affect the stock market.
Oh, okay.
So once you start to see wholesale sell-offs start to occur early, obviously you've developed some predictive analytics to be able to start measuring some of the inflection points and some of the momentum trades. As the asset values start to decline, if it looks like there's some momentum there and you're moving into a correction, then you would start to sell short. Or write the calls or buy the puts.
So it'd be nice to know the intrinsic value of the stock, because if its actual value is much higher than its intrinsic value and the interest rate's already rising, that means it probably has a decent way to fall.
Yeah,
So you'd wanna pick actually stocks that are way overvalued
Yeah.
and short those.
yeah, so that's why when, in the class, what we're gonna do is when we do the stock valuations, we'll be doing sensitivities on the discount rates that will include some projections of higher risk-free rates under a higher interest rate scenario.
Cool.
Okay. Did that answer your question?
I'm still confused on what the CV equation is and what the two
Which one?
objectives are. So it's, the question I guess is, show how they can be better off using the inverse coefficient of variation equation. What two objectives
That's
are
what
you?
this is. Because the coefficient,
Oh,
coefficient of variation equation is standard deviation divided by expected return. So the inverse is this.
oh, okay. And then what two objectives are you as the portfolio manager trying to achieve? So basically to,
Well, you're trying to get
Lessen the risk.
diversification, right?
mhm,
Lower the risk.
mhm.
And if you locked in the return, you're gonna increase the risk-adjusted rate of return. That's the objective.
Okay,
So there's like three, right? One is diversification, right? To lower the portfolio risk. The other is to lock in the return, and the other is to increase the risk-adjusted rate of return.
okay.
So those are your main objectives.
Yeah, Yeah, I guess I actually did that, I just didn't realize that was.
Yeah, I didn't really probably
CV.
go over it as,
Okay, well, great, thank you.
yeah. Any other questions on this?
Could we segue into derivative trades?
Yeah, so we already know the down trades.
The down trade, oh, that's down trades?
Yeah, these are the trades for prices that are going down,
Okay.
okay? And then now we just need the ones that are going up, right? And remember, the ETFs and the stocks are the exact same trades. Okay, so if prices are going up, you have your index trade, you got your ETFs, and you got your stocks. And then if you think the prices are going up, you're gonna buy forwards, you're gonna buy futures, you're gonna buy calls on the futures, and you're going to write puts on the futures. Okay, and then here, on the ETF and the stocks, you're gonna buy on margin. And the same for the ETF is the same for the stocks. Then you're gonna buy calls. Buy calls. And you're gonna write puts. That's it. So I'm testing you to see if you know the two sets of trades, because there's only two sets. Okay, any others?
I think at this point, just like, if you make sure to memorize the stuff in there, memorize, you'll be alright.
Huh?
I think at this point, if you memorize the stuff, like all this stuff, I think it might be alright.
Yeah.
Just to make sure, I'm trying to quiz myself here.
Remember you have a photographic memory.
Oh, yeah,
You will remember everything you see.
Isn't,
You have instant recall, and you're gonna ace the test. You guys have to
Isn't that
memorize
what
that mantra.
isn't
No,
there like
listen,
a
you're gonna be
record-
taking the CPA exam. You're gonna have to ace that thing. You're gonna have to have a photographic memory to be able to be able to absorb all that content and then ace the exam. If you guys are gonna take the 7, the 66, the CFA, any real estate license, any certification, you gotta have a photographic memory. The bar exam, whatever it is, GMAT, LSAT, you already have a photographic memory because you already remember people's faces and you know their names.
I'm actually really
So
bad.
you
at
already
that.
have it.
I'm actually really bad at that, honestly.
Yeah, but you know how to get home, don't you? You remember your phone number, don't you?
I remember my phone number.
You remember your social security number. So you already have those capabilities, you just need to develop them. But you need to be able to tell yourself that when you fall into REM sleep, and you need to do it when you come out of it. What'll happen is your brain will basically be trained through hypnosis to basically be able to train it to have a photographic memory for instant recall, to be able to ace the tests.
Well,
That's how I got past all the exams.
So you said,
I tried doing that more or less than these.
Yeah, exactly, so you're gonna memorize that
tell
stuff.
yourself during REM sleep to remember?
Right when you fall in from wake
Oh, yeah.
through REM
Not glasses on.
into sleep, you need to say
Very
that
simple
mantra
information about
in your
that.
head. And then when you're laying there in bed, coming out of sleep into REM before you wake, you need to be telling the mantra to yourself. And what'll happen is you will self-hypnotize yourself to be able to do that stuff.
You still remember that thing said?
But
All the stuff that you learned on this side?
I remember a lot of it. But I have to go back and reinforce it and reread it and stuff. Plus, I'm always learning new stuff. But I developed this stuff, I developed this myself. This was mostly Markowitz's model. And then I developed this piece right here. And then, came to this conclusion, set up this, basically the binary rules for derivatives. And then kind of locked this piece in, and then notice that the insurance, because went into insurance, notice that the model the Markowitz model needed to be modified to take into consideration alternatives, which were a new asset class. So I modified the model. And then the third piece of the model was to add in the wealth effect of the insurance. And I wouldn't have done that by reading corporate finance yet.
Yeah.
It was because I was in the industry and thought about it for like 4.5 years. And then started teaching it and said, oh, I was in alternative renewable energy consulting for 10 years. So it's like, oh, figured this stuff out. And like, figured this out, and then went into insurance and said, well, the insurance needs to be in here. They gave me the research paper, okay, got it. And I was like, oh, wait, look, this needs to be a modification here into the Markowitz model to take into consideration the wealth effect, and oh shit, look, they get up on the higher utility curve.
So with insurance, you figured out that you could have a better RAR.
You would have a better outcome, but you have to die. But you don't care about yourself, you care about the people after you.
That's true.
Mm-hmm.
So it's not, I hear it all the time, all my clients and prospects, where it's like, I'm gonna divorce her anyway, and I really don't like my kids. And my family, I'm not gonna give them anything. Seriously, I
You hear
heard,
people do that?
I heard people say that stuff.
Okay.
And I'd say, hey, dude, it's only like $800 a year for 20 years for $1 million. Just do it. Just do it. Or you wouldn't do it. They were too cheap. They were out hunting, in the wilderness because they wanted to use the $800 to buy ammo and some AK-47s or something like that. Some weird shit.
If you don't like your wife and kids, that's a pretty good idea.
Huh?
But if you don't like your wife and kids, that's a better investment.
No, but the whole thing is that the life insurance, once you lock it in, like into your age, if you buy convertible term insurance, when you go work for a company, let's say you become uninsured. Now you have that death benefit that you can use, particularly if you go to a startup. You can convert the life insurance once you get it and become uninsured. They don't take it away from you. You can convert it into permanent insurance and guarantee that the $1 million is going to be paid to your kids in 50, 60 years from then, once it's all paid out.
Huh.
You can't go back in time. I haven't figured out a time machine yet.
Do we have life insurance?
Okay.
Do we have life insurance or is it?
It's life insurance, not
So
health.
we
Health
have
is
life
different.
insurance.
No.
We have health insurance.
Yes.
So you can only get life.
You have to go through an agent and then buy life insurance. I would say buy convertible term insurance. And if you can get 30 year, that's awesome. But a term policy convertible for the next 20 years probably costs you $500 a year. Level.
That's not
That's
that.
not bad.
Level for 20 years. No, it's not, for $1 million.
Yeah.
So if something does happen to you, and I had some of my clients, they died at like 25. Yeah, either got cancer or something, and some of those guys, they didn't have any insurance. They had 3 kids and a wife. So now the grandparents and their families gotta take care of them.
So they won't give it to you unless, if you have something wrong with you, you'd have to be,
Yeah, you gotta be in good shape. I mean, if you had cancer and you beat it,
yeah.
and you haven't had it for 5 years, you can get the insurance. But if you have like Crohn's or some kind of autoimmune,
Reoccurring, yeah.
they're probably not gonna get it. That's why you get it early and then you keep buying it.
So
So I'm
yours
probably gonna
is-
buy I'm gonna buy another $1 million. For 30 years, it's gonna cost me like $400 a month.
So you can get it multiple times, so if you die,
Yeah.
you can get like 400 million.
Yeah, like I'm just layering it, I already got $1 million something from my wife. So if something happens, I wanna get another $1 million.
And then that would go.
And if I get it for 30 years, I'm gonna be 57, 60, 70, 87 years old. $400 a month for a potential $1 million payout. By the time I'm 87, I'm not gonna make it, right? Probably die around 80, most people do.
Nah, you'll be.
Well, I'm just saying, but if I do, my sister, my brother, my nieces and nephews, they're all taken care of. $1 million will go.
So with life insurance, is it only, it's not natural cause that you get money though? Or if you die?
You have to die from, you can't have your buddy kill you or something.
Can you die from natural cause and it's still
Yeah.
a life insurance?
Yeah, and it'll pay.
Oh.
They'll investigate it though.
Yeah, but if you're in a hospital and you die from natural causes, the insurance company's gonna pay.
Oh. Wow.
Yeah, it's the cheapest, I mean, we're in the capital markets, is what I tell my students. We're in the capital markets. Can you lease an asset of $1 million for $500 a year? You're leasing it.
Yeah. That's
So
nothing
$500 is nothing, it's dear.
compared to $1 million?
Yeah.
It's nothing. $1 million, 30 years, level premium. Premium never goes up. And if you get sick, and you become uninsurable, they can't take away the policy.
I understood life insurance.
Yeah.
So what age should we get it at?
20.
20?
Yeah, I bought it because I wanted to make sure that if anything ever happened to me, my parents got $1 million. You know, so they could buy off the house, and you know, there was money around.
Have you always, since a young kid, known that you wanted to do this?
I wanted to do engineering first,
Okay.
and
You
then
got an unbelievable mind.
and then I decided I had to go do something different, right? Poli-sci, that stuff. You know, that's what I wanted to do. My dad didn't want me to do that stuff, so I said, fine, I'll go study business. So I started in finance, went into econ, went back into finance, did real estate, and then just kept layering in the education to just crank through, you know, and just make myself smarter and stronger and smarter and stronger. So I could probably be doing other stuff. You know, I probably should be doing other stuff than being here.
You're helping us though. I mean, this is amazing.
But I'm helping.
I appreciate it.
Yes,
Yeah,
you're
very
welcome.
cool.
You're welcome. So, what other questions do you have?
Real quick, could we go over the definitions of, so buying calls
Yeah.
and puts, right? Buying is obviously buying, writing is the
Yeah.
reverse, right? It's selling.
Yeah, it's just the reverse. So the way that I modeled it out is, so here's your forwards and your futures. Okay, so I'm gonna buy this contract, this forward contract, okay? And it's gonna be for 2 years, okay? Now, we can't buy forward contracts because only large corporations and institutions can do it. So what they're doing is they're betting. So I'm gonna enter into a contract, let's say, where oil's trading at $50 a barrel, okay? And that's the exercise price, okay? And I think that the prices are gonna go up to 90 or 100, right? I think over the next 2 years, they're gonna go up to $100. Well, at the end of the 2-year period, the forward contract exercises, and I walk away with, you know, the $50, right? I exercise it at 50, sell it at 100, I pocket the $50. Okay. The other person, I thought it was gonna go up, so I bought the contract. There's somebody else who wrote the contract. The writer has to pay me the $50. Okay, so he lost, or she lost. But if I think oil prices are gonna go down, I can write the forward contract. And at the end of the end of the period, let's say they go to $25. Oil prices go to 25. Then basically the buyer of the contract has to pay me the $25. So I can bet either they're going down or they're going up, okay, in oil prices. And if I think oil prices are going up, and one of my biggest inputs is oil, you know, or gasoline into my business production, I'm gonna wanna hedge off the risk of, you know, oil prices going up. But if I'm the oil company, and I think oil prices are going down, I wanna hedge off, you know, my revenue's gonna decline because I'm gonna be selling at $25 instead of 50. So I wanna write these forward contracts to then get, at the end of the 2-year period, the person who bought it pays me the $25, and that basically offsets my revenue loss. So I hedge off the risk.
So what are calls and puts?
I'll get to that in a second. And then the futures contract is basically the exact same thing as this. But the thing is that over the I'm buying a 2-year price. Okay, so I'm trying to figure out what the price is gonna be in 2 years. And that 2-year price is gonna change every day,
Yeah.
right? So every day, it's gonna go like this, and then maybe it goes like that, okay? So every day, above the exercise price, money's gonna flow in to my account, and then it's gonna really start flowing into my account.
The closer you get to that 2 years.
Yeah, because I'm just saying they're settling every day,
Oh.
okay? But on the days that it's below the exercise, money's going out of my account. Okay? So this is buying a forward contract, a futures contract, okay? They're standardized and they trade on an exchange, and they settle every day. Forward contracts are in the over-the-counter market, they're custom, and they settle at the end of the 2-year period, okay? And then for the person who's writing the forward contract, he thinks the prices are gonna go down, the other person thinks it's gonna go up. If they go down, then I'm making, I'm making all this money. Right? So as the price starts to go down, I'm making money.
So can you only do this with broker?
Yeah, you gotta go through a broker. And then usually what they'll do in both of the forward and the futures contract scenarios, let's say I bet that the prices are gonna go down, but they go up. So since I wrote the futures and the forward contract, once I start to see I'm losing money, I'm gonna buy a forward and a futures contract to cancel out the position.
How-
So that's how you do it.
I've heard that like in the
You don't just you don't just bleed to death. You just take the offsetting position and then you call it quits.
I've heard in the options and or futures, one of them is that you could leverage and you can make like 10 times returns.
Yes.
How does that
That's correct.
work?
Because you're not buying any underlying.
Oh,
You're just
okay.
buying these contracts that are highly
And
leveraged.
so you don't even need to have.
If you're right in the direction,
Uh-huh.
if you're right in the direction and you're right, you're gonna make a shitload of money.
So if you have like.
Because you don't own anything.
You
Right.
don't even need liquidity to buy it. You don't need your money to buy these shares.
You don't not buying the underlying asset. You're not buying gold, you're not buying oil, you're not buying stocks, you're not buying bonds, you're just buying these derivative contracts based off the indexes.
Huh.
So you're leveraging your position if you're right.
How do people not do this? I feel like
Because it's too complex. And this is the call option, right? So there's an exercise price, I'm gonna pay a premium, right? When I buy it, the stock price is gonna have to go up to pay me back for the money that I put out for the premium, kind of reach some kind of break even. And then this is the price of, let's say this is $50. So I got the right to buy it at $50. Stock price goes to 100 over the 3-month period of the option contract. At the end of the period, I exercise the option to buy the Apple shares at 50. I sell them at 100. I make the $50 minus what I paid for the premium, and then that's the profit. So I'm in the money here.
And so that's a call.
That's a call option.
And a put is just the reverse.
Yeah. So the put kind of, it's not looked like this, but I do it this way because it's just easier to understand. It basically looks like that. So obviously you're gonna buy a premium, right? You're gonna buy a put there. And then the price has to drop. Let's say we use the same $25. So the price has to drop enough to pay me back for the premium that I bought it. There's the exercise price. So the stock drops to $25. I exercise it at 50. I pocket the 25 minus the premium. What's left over is the profit.
So it's kind of like what those guys did in the Big Short, is they bought on a premium for a swap and then they cashed in when it
Yeah, they were
bought-
shorting the whole thing.
Shorting.
But they were on forward contracts.
Okay.
Everyone
They were
was
using
laughing
forward
at it
contracts.
'cause they were shorting the bonds, right?
Yeah, they were shorting the bonds, so they were forecasting that the bond prices were gonna go down significantly, which they did.
Is that the first time ever someone has shorted a bond?
The ability to short bonds and these derivative contracts came out in the 70s.
Okay.
But nobody made as much money as those guys
They
did.
did, right?
Yeah, because the Federal Reserve stepped in and basically paid these insolvent banks. And the insolvent banks basically settled all the trades between each other.
Stop people.
And then they made like a shitload of money. Our money. They took our money, basically. Because the system, if the trades didn't clear, then the whole system would have seized up and we would have gone into a depression. So they had to pay off the crooks to keep the system alive.
So you think TARP was a good idea then?
I have problems with it, but it worked.
Yeah.
The Federal Reserve credit guys, are really, really smart. They knew exactly what to do. But we shouldn't have gotten into it in the first place. So the last piece here is, so I think the prices are gonna go down, so I'm gonna buy a put, right? If I think prices are gonna go up, I'm gonna buy a call. If I think prices are gonna go up, I'm gonna write a put. And if I think prices are gonna go down, I'm gonna buy a call. And I'm going to write a put. Write a call. Sorry about that. So that's how I remember it. So I start with this, okay, buy a put, buy a call, buy a put, write a call.
Mm.
Okay, buy a call, buy a put, write a put. Buy a call, write a call. Okay, once you learn the logic, then it becomes easier. So when I buy the puts and the calls, money's going out. When I write the calls, money's coming in. I pocket the money. What's the difference? Okay, I didn't answer your question. That's kind of the mechanics between those things.
Yeah.
And then the futures and the futures contracts.
It's the same thing, right?
Yeah, you're buying and writing puts and calls on the futures prices. Okay, the prices of these contracts.
Oh,
So it's a derivative of derivative.
so,
That's what it is.
Double derivative.
It's a double derivative.
so for options, it's like if it goes above 50, whereas with
Yeah, if you
futures,
bought
yes.
the call option and it goes above the exercise price, anything above the exercise price is gonna be your profit.
But with futures, you have to guess the specific price.
You're actually, the price of the futures contract is gonna be 2 years out. So 2-year forward price is moving, but you're settling today.
Okay.
Does that make sense?
That's pretty. I don't know. That's pretty confusing.
Well, because people are looking, different types of people, particularly commodities traders that, around pork bellies and orange juice and those things are usually looking out a year or two.
Mm-hmm.
So they're trying to forecast the price, try to hedge off the price a year or two in advance based on the commodity.
But they settle it instantly. They
And
don't.
it settles every day based on a forward price.
But we don't know what that forward price is.
Yeah, it's priced, it's traded every day. The contract's traded based on the forward prices.
So like the contract today will be finalized like.
So I could buy a contract
Okay.
with prices 1 year out,
Mm-hmm.
or I could buy a contract that are looking at 2 years
Okay.
or 3 years. So those prices are gonna change,
Mm-hmm.
okay? And if you're in the money, money goes into your account. If you're out of the money, money goes out of your account.
Oh, that makes sense.
So you're just guessing the direction it goes.
That's it. That's
Oh,
all
okay,
these things
yeah.
are.
Yeah.
All these are. So you do the economic and the financial research and you become good at forecasting, and you can forecast prices, which is why we're doing the memos. If you can forecast the direction of prices over some time period, then you can apply the derivative contracts and profit, or hedge your risk. Okay. And we usually don't get to this point in the class until like chapter 20. I'd rather not put
I like it.
so we can get it done, so that by the end of the class, we're not just, usually what the professors will do is they'll just skip over it. And they'll say, we don't have time to do it. You'll get it in investments.
It's getting me excited.
Okay, any other questions?
I'm good.
Maybe intrinsic valuation theory.
Okay, that's pretty straightforward. Okay. You guys want to take a picture of this, or you got it?
We need to explain it. Don't worry.
Okay, you guys get this?
Yeah.
Can I do it?
That's not that
What time is it?
3:35.
Huh?
It's just
What time is it?
It's 3:35.
Okay, perfect, so we're right on track. We covered a lot.
Yeah. Should review it a little bit, but yeah.
Okay, so the intrinsic value theory, I mean, in your problems, in your problem sets, in your homeworks, and in your, couple of the problems in the back, those are all application, but I want you to memorize the theory.
Okay.
And I came up with my own nomenclature. Okay? Because it was more intuitive for me than just using the book's nomenclature.
Mm-hmm.
So the perpetuity model. So the perpetuity model, the first one, assumes that the cash flow 1 year out divided by your expected return is going to give you the value. Okay. So this cash flow here, CFO T plus 1, this could be earnings per share. This could be EBITDA per share. earnings. This could be EBITDA. And if I'm doing it on a per share basis, I'm valuing stocks at a share basis. And if I'm using total earnings or EBITDA, I'm doing firm valuation.
Is that still perpetuity?
Yep, that's perpetuity.
All of that?
That's all this is. And then I'm just giving you some definitions for here. And then I is gonna be your discount rate, could be your cost of capital, could be your expected or required return. It really depends on who you are, where you're coming from.
Is the I the one on the bottom?
That's the discount rate.
Oh, that's, okay.
That's your discount rate, your required rate of return, your cost of capital, whatever it is you're trying to apply. And this assumes that the cash flows are gonna remain constant, flat, forever, into perpetuity. Okay, and then your Gordon growth, or what is the constant growth, is basically the perpetuity model that's been adjusted. So the cash flow T plus 1 divided by I minus G. And G is the constant growth rate in the cash flows. And they assume that the cash flow is going to grow at a constant rate in the future. That's your Gordon growth. And then the third model is the multiple approach. Okay. And that basically takes the same cash flow, CFO T plus 1, and you multiply it by a multiple T plus 1, and you're going to get a valuation using the multiple approach of T plus 1. These are all T plus 1. Because intrinsic values, you're valuing future values. Okay, and then the question of what's the multiple? So the multiple can be many things. It could be the sales price of the company divided by the EBITDA. So I can go find 3 companies that sold similar to mine, find the sales price divided by the free cash flow, and I can get a multiple. So I can do that, or I can use earnings. I can do that too. Or I could do the stock price divided by the EPS, and that's going to give me my price to earnings multiple, my PE multiple. And I can actually create another multiple, 1 divided by I. I can create a multiple. I take that multiple divided by the cash flow, I'm going to get the perpetuity valuation. I can also create a multiple, I minus G. It's going to give me a multiple. Take the multiple, multiply it by the same cash flow. I'm going to get the valuation of the Gordon growth. So I can do that too. So this multiple is going to give you that value. This multiple is going to give you that value. It's the same thing. And then these I go into the marketplace and I find these. Okay, and that's the multiple. And then the DCF, this kind of cash flow, I'm going to do a 2-period model. I'm really looking for the present value of the DCF. I'll do a 2-period model. This is how I like to set it up. Like this. Like that. And then I know that this is what, 1 plus I to the 1, and this is 1 plus I to the 2. And I gotta get the first year's cash flow. So the first year's cash flow is, CFO T plus 1 equals CFO T equals 0 times 1 plus G. So I take last year's cash flow, I grow it out, I get next year's cash flow. Plus 1, I make sure these match. Okay. And then what I'm going to do is I'm going to grow this out. 1 plus G, and I'm going to get CFO T plus 2. Then what I'm going to do is I'm going to grow this out. 1 plus G, and I'm going to get CFO T plus 3. And then I'm going to take the third year cash flow, and I'm either going to divide it by I, if I think that the cash flows are going to remain flat forever, or if I think they're going to grow at a constant rate, I use the Gordon growth model. And then I calculate the terminal value. And then I take the terminal value, and I add it to the second year's cash flow. And then I discount it by the discount factor to get the discounted cash flow for year 2, DCF for year 1 equals present value DCF. So that's kind of how I do it.
So,
So you gotta grow it out one more year and then apply. So the perpetuity Gordon growth, get the TV, and take the TV and add it to these two. And then discount it back. And then sum them up. Get the TV. Boom.
would you say this is the most reliable way to see if it's worth investing in a company?
The most investment managers will use these two.
Okay.
Because these two are embedded in here. And this one's usually this is a least probable scenario. It's like a lower bound because there's no growth rate in it, so it's a conservative valuation. Then this one's too simplistic, but it gets more realistic.
Yeah.
This one's extremely realistic, and this one's theoretical, but it's another more accurate method. But the majority of venture capitalists and investment bankers will use this.
Okay.
And then investment bankers doing high-tech companies will use this. And then if they're doing more established companies, they'll use this and this. Okay, any other questions?
I was gonna ask the dynamic yield curve and Standard & Poor's. Is that just
Oh,
you
yeah,
gotta
yeah.
look at?
That one is this one. We did this, so this was the Standard & Poor's. It went like this,
Oh, I
and then it went like that,
Yeah.
right? And then you have the yield curve over here, right? And then what happened is we noticed that the yield curve, right, was upward sloping in this period, upward sloping, started to flatten and then inverted like a year before, right? And then down here, it started to flatten, and then it was normal again, right, like that. And then it was normal, then flattened, and then inverted 1 year prior to the peak.
If we explain that in writing instead of the diagram, is that okay, or are you looking
Yeah,
at
that's
the
fine.
diagram?
Yeah,
Okay.
I just want you to be able to say that once the yield curve inverts, the S&P 500 peaks in less than 12 months.
Mhm.
And once the yield curve inverts, we're in recession in less than 24.
Yeah,
That's it.
okay, and that basically it flattened and then it,
Yeah, so there's normal, flattened, inverted, peak. Normal. As you start to get to the peak, then the curve flattened, inverted, right?
peak
And then,
recession.
and then as you start to get in, the Federal Reserve starts to drive the yield curve
Oh.
normal again. Because they're driving down interest rates on the short end of stimulate the economy.
I actually do like that diagram now, it's fine for
After
Yeah, it's a
the-
little bit more dynamic, but
Okay.
here, we're like, this is normal, and now we're getting flat,
Mhm.
right? So it's gonna go like this at some point.
Okay.
So we're not here.
We're looking out for that.
This is 10 years, right? So we're getting close.
Thank you.
So once curve inverts, it will peak in 1 year and it will.
Once the
be a
curve
recession.
inverts, the stock market peaks in less than 12 months, and we're in a recession in less than 24. And that's based off the theory that I've seen. And I'm constantly looking at that.